Welcome to today's update from Lazard on global listed infrastructure. I'm joined by the Lazard portfolio manager and analyst Warryn Robertson of the Lazard Global Listed Infrastructure Fund. Warryn, thanks for joining us today. One of the hot topics in global markets at the moment obviously is interest rates, and interest rates have a fairly large impact in terms of the global listed infrastructure asset class. So given the view of the market that it's lower for longer, what in your view and what is your base case in terms of the effect or impact on the asset class?
Sure, Ben. It is the big question at the moment. We've seen interest rates now reach historically very low levels, and the market has cheered that movement and particularly for infrastructure stocks, in the belief that the lower cost of capital will be reflected in high multiples that people are prepared to pay for these assets. We caution investors with that very simplistic approach for two reasons. One, the reason interest rates are lower is the expectations of reserve banks around the world and many other commentators is that growth will be lower. If that is to be the case, then the lower interest rate and the lower discount rate that you apply is going to be offset by lower growth rates. The problem we see with investment markets today is they seem to be banking on lower costs of capital and lower interest rates forever, but a return to trend growth rates. And that is a disconnect that we think is breaking what we call and what economists refer to as the golden rule, which stipulates that nominal GDP growth in the long run will be equal to the nominal risk-free rate. And linking those two numbers together is critically important. You can't, there is no free lunch in life. You can't have low rates and high growth. It just doesn't work that way. And it's particularly the case for infrastructure stocks and in particular utilities, who in essence, as interest rates fall, should be compensated with lower regulatory returns. Now that's a explicit program that occurs in the United Kingdom, in Australia and in Europe. But in the United States, it's an implicit rule that takes some time for the mechanisms to work through. And so what we find is that today, US utilities are banking on regulatory returns staying at 20-year averages and risk-free rates staying at historical 100-year lows forever. That broad gap is what we're questioning in terms of the valuation of US utilities today. And it's the reason that we struggle to find any value in that particular segment of the infrastructure market.
So Warryn, the portfolio does look very different today than the general indices of global listed infrastructure. In particular, you've touched on the reasons and rationale for the underweight to US utilities. But obviously there are some fairly strong overweights in the portfolio, particularly towards some sectors and regions, specifically Europe. Could you take us through the thesis behind that and also to just a bit around the portfolio positioning today?
Our positioning around Europe is very simple. It comes down to one word, and that is valuation. We're bottom-up stock pickers, and we see great valuation opportunities in Europe. In particular, the country that sort of stands out in our portfolio is Italy. The three stocks that we have the largest positions in that particular country are Snam Gas, Turner, and Autostrada or Lancia. Snam Gas and Turner, monopolistic regulated utilities. The market is concerned that the allowed returns will be based upon a European bond yield and not the Italian bond yield, which has been the case now for more than 20 years in terms of the way they're regulated. Why is that important? Well, European bond yields as issued by the Bundesbank are yielding about a 1.5% lower return than what Italian government bond yields are. The market's concerned that those lower bond yields will find their way into the network charges that are being allowed for our monopolistic assets. We are confident that it will continue to be the Italian government bond yield, and in the last 3 months the Italian regulator came out and reiterated the point that yes, it would be Italian government bond yields, and we've seen Snam Gas and Turner appreciate accordingly. The other stock that we own is Lancia. It's the owner of the Autostrada concession, 2/3 of the motorways across Italy. It's also the owner of the Moldai Bridge in Genoa, which was the scene for that tragic accident now more than 12 months ago. That accident has been the cause of some share price decline and weakness. And what we have included today in our valuation of Atlantia is the most punitive outcome of any redress regarding that particular accident and incident. Under the concession arrangements, the concession can be revoked by the Italian government so long as they pay a penalty of a 10% discount to the remaining NPV of that concession. That is the assumption that we have made because it is the most conservative outcome, although we do not believe it is the most likely outcome that we will see. Notwithstanding that 10% penalty, we still see significant value in Atlantia today. And of course, Atlantia also owns Rome Airport. It also owns the largest motorway network in Spain as well. So it's not just that one asset that we are banking on in terms of our valuation.
It's a challenging environment, obviously, in allocating capital in the global listed infrastructure space, as you've described. So in terms of the constraints and challenges for you actually shaping the portfolio, how has that impacted and what is the portfolio looking like today?
Yeah, it's a great question. Look, ideally, we would love to have 50 individual names that were all returning CPI plus 5 across many of the different countries of the world in many different sectors. That's not the case as we see it today in terms of the value opportunity set. For us to achieve our performance objective, we need to be concentrated in a number of select opportunities that we think will generate those excess returns for our investors. Today, as I said before, many of those opportunities exist in Europe, where we see, from a bottom-up perspective, some very compelling valuation opportunities. But again, we're into territory that requires us to invest in a select number, so we only own 25 stocks, and the value opportunity set looks limited. That said, if I was to look at the broader infrastructure universe, it looks reasonable value when compared on a relative basis to both equities and bonds. But frankly, Ben, that's not setting a very high benchmark. We see investment markets as being challenging across the board, and we think investors, the best way to confront those challenges is to concentrate their investments into known investment opportunities that we think will generate good returns over the longer term. Today's not the time to be broadly diversified in 100 plus infrastructure names. We think that is exactly the wrong way to build a portfolio today.
Thank you for that, Warryn. So, I mean, the underlying objective of the strategy is CPI plus 5, and those investing in the infrastructure asset class would expect to see a high level of income, given the sort of securities that you're investing in. Given the challenging starting point you've described, how do you view that objective, the likelihood of achieving it, and sort of how has that actually impacted that on behalf of investors?
It's important to contextualise why CPI plus 5 was the investment objective. Primarily, it really does position infrastructure in between bonds and equities on the capital markets line. And so we think in a normal investment environment, investors should expect a return of around 5% from bonds, say 10% from equities, and infrastructure would sit in that space in between, hence CPI plus 5 or 7 or 8%. We're not living in normal investment markets today. There's no newsflash there. We see bonds as struggling to achieve 5% in the long run. We've seen, Australian and US government 10-year bonds now at below 1.5%. We think equities will struggle to do 10%. So likewise, we're finding it difficult to achieve that performance objective if we were to own, again, a diverse range of infrastructure names. So what we have done as a team is to concentrate the names into those select opportunities that we think can achieve at or around that return, and to concentrate the portfolio into those names. They are typically highly free cash flow generative, and that's why you've seen a strong dividend yield as a major component of our return over time, and we still believe that will be the case today. The predictability of infrastructure assets, their ability to generate cash in a range of economic scenarios, is why investors flock to them in these challenging economic times. But we would caution investors just to blindly buy all infrastructure assets, because all of them are not created equal, firstly, and secondly, today, not all of them are going to offer you defensiveness in terms of stock price resilience in a downturn. And that all comes down to valuation. If you're buying an expensive asset, it doesn't matter how good a quality it is, it won't defend you in challenging markets.
So Warryn, thank you very much for your time and your insights today. Thank you for tuning in. If you would like further information on the Lazard Global Infrastructure Strategy or any of Lazard's strategies, please go to our website, www.lazardassetmanagement.com. Alternatively, also you can contact your local representative, also be able to find them on the website. Thanks.